we're going to be going over a brand new construction property, only 7 miles from downtown Jacksonville, close to 55,000 jobs. It's going to generate a 7% ROI.
You know something funny? One of my teammates, Tara, she's been listening to the show, of course, and my team gives me great feedback on the show, just as you all do. And she's like, Greg, you sound like so monotonous. She said you sound kind of like Yogi Bear when you start the show, whenever you say, hey, hello, everybody. Great to be with you. So now all I'm thinking about doing is saying something completely different going forward. So I'm not Yogi Bear up here.
Well, the good news is that you're going to have the chance to do that, Greg, because we are officially right now live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the Week.
Week.
I am your host, Pablo Gonzalez. With me, as always, the man that I affectionately call GC because of his genius concepts, because he generates cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greggy Bear.
Hello, Not Your Average Investor Show community. It is wonderful to see you all here enjoying the show, just like Pablo and I are. I can't wait to be with you today.
Man, that sounded very unbear-like. Good job, buddy.
Not your average bear.
And we're happy to have everybody in the house, the Not Your Average Investor Show familia. As you know, if you are looking to find out about how to own rental properties in your portfolio, you've come to the right place. If you've come to find the best property management practices for rental income property investors, you're in the right place. And if you just want a legit edge on the Jacksonville real estate market because you're a real estate professional and you're looking for opportunities for you and your clients, you're in the right place. Next place to go is chatwithjwb.com to dial it in for exactly how it fits with you. But right now, GC, it is time to welcome our community. Put it in the chat if you're here, where you're coming from, so we can say hello, because we're about to hit this roll call. You ready, GC?
Let's do it.
Let's do it. Carl Thompson, good morning, everybody. Hope you're doing great. John Henning, good afternoon, all. Leo, good morning, all from California. Leo, Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
She says hi, folks. Denny Davies is saying howdy from Germany. I heard they speak howdy in Germany over there.
Great to have Denny here.
Lydia fills in, says hi, y'all, in a quintessential Florida fashion, since she is descendant to Florida royalty. We know this. Lee Bishop is in the house. Hey, everybody, sorry to say, Jen and I cannot host the Baltimore meetup this year. Not enough time to put. That's all right, Lee. You've done plenty for the community. We're not doing the Baltimore meetup just yet, but we'll figure something out like that. Marilyn Cotterman already said boo-boo bear. Daniel Lee says hello from Philly. Hello, Daniel. Good to have you from Philadelphia. Saori Bezuska coming in from San Diego. Good to see you, Saori. And Lee asks, is Pablo wearing a Not Your Average Investor Show swag in a deeper color blue? No, Lee, you're almost right. I am wearing can you see it on the map? I don't have the camera.
You can.
I am wearing a JWB shirt that you may or may not have seen on television. I was honored with being in a JWB commercial earlier this week, and I'm sporting this fancy blue shirt that Greg got me over here. And
suits you well.
It does, man. I like it. It doesn't it hides my little shoulders, right? Like it fits me. It fits me nicely. You know that I'm real self-conscious about that. And yes, Lee, I did not have to wait 6 months for it, though. I waited a year and 6 months. Lee, I've been doing this a long time now. GC, you ready to get into this?
I'm so ready. I know what's coming up next, and it starts with a little beep, 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 beep.
Well, before that, I don't know what you're talking about, but
Maybe not. Maybe I don't know.
Before that, I want to encourage everybody, before we get into the property, to go to jwbinventory.com so that you download the spreadsheet. You can fiddle with it from home and do it alongside us as we are getting ready to show this. But you're right, Greg. We got a beep, 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 beep. Breaking news, Greg. What is happening right now in the world of rental income properties?
The best type of breaking news, the type of breaking news that is going to have a positive impact on your return on investment immediately if you are an investor who is buying properties in your retirement accounts. So non-recourse financing, as we know, is very different than conventional financing. Everything about it is different. If you haven't heard of non-recourse financing before, that's what's necessary if you want to invest in rental properties and do it in your retirement accounts. And everything's about it. The rates are different. The terms are different. The way that the interest rates move or don't move is very different. It's not like your normal mortgage rates that, move more often and that are incredibly low for conventional financing. It's just a different ballgame in non-recourse because this is a more risky type of loan to a bank because it's made to your retirement account and they don't have recourse against a credit score if you wouldn't make a payment. Well, this non-recourse financing is really important to investors, JWB investors, other investors who want to buy rental properties, and rates have always been higher. And that should make sense to everybody because, again, it's a more risky product to a bank because they don't have the same recourse as if it was a conventional loan. Typically, those rates don't move very much. And I'll tell you, at one point, the best rates that we could find out there were 12% interest and a 10-year term, right? 12% interest seems high, right? Your eyebrows raised, right?
Yeah, that's super high.
Yeah. And at a 10-year term, which means that you pay a lot more back each month if the loan is only 10 years long versus a 30-year term. So hard to make the cash flows work if you have that high of interest and a 10-year term. Well, we're always on a mission to see how can we live by the basic tenets of what we believe are the best part of this investment, right? Risk mitigation, which means that it pays for itself every single month. And then, of course, holding on for a full market cycle to achieve the maximum upside from your 5 profit centers. We continue to work with our partners, our non-recourse partners, to try to get those rates more palatable, right? Tough to make a bank feel like they want to take a riskier loan and get those rates down. But over time, that's what we've been able to do. At one point, the rates dropped from 12% down to 10%, right? At one point, we were able to extend the loan terms from 10 years to 20 years, right? At one point now, prior to this conversation, rates had dropped. We were able to work with our partners to get those rates dropped to 7.75%. We were able to extend the terms of the loan to 25 years, which is great because that's how you make the cash flows work, right? Well, the most recent update and the thing that I'm happy to share with everybody is that the rates have gotten better, okay? So this is something we're going to be able to do here right on the show. We're going to show the impact if you're buying properties in your retirement accounts of a lower rate and a longer term today. It's going to have an immediate impact on the return on investment for anybody who's buying the property of the week today using non-recourse financing. This is an amazing thing for you. So the new rate is 6 3/4. 6.75%, and that's fixed, which again, for non-recourse is a huge win. I know some of you may say, well, geez, conventional financing, I can get rates at like 4%. Totally different ballgame. Can't compare the two. To get 6.75% on non-recourse financing is the best that I have ever seen, the best that we've been able to do for JWB clients. So that's fantastic. Loan amount. All right. Normally you had to put 50% down. Now our partner is only requiring 40% down. So that means if you have enough in your retirement account with 40% down plus reserves, you're going to be able to buy properties. It's going to remove one of those barriers of entry for those who might have a limited amount in your retirement account. So that's a wonderful thing. And then the term is now 30 years. You get to borrow this money for 30 years. And you know how I feel about investing in hard assets that have 5 profit centers. Doing it for 30 years, paying 6.75%, holding on it for 30 years as a way to diversify your holdings in your retirement account can be a wonderful thing for some of you and most of you. And if you have questions, if this is for you, please talk to my team because this would be a wonderful conversation. But that's it. This is a partner that we have worked with for many, many years. This is not a new partner to JWB. So we don't have risk of bringing somebody new into the system and their performance. That partner continues to get better and better. And so we're really happy to roll this out to everybody who's interested in buying a property with non-recourse financing.
Man, when you told me that there was an update, I thought you were just going to say that rates dropped, but this is like a huge win, right? Like the rate dropped, the term dropped, the term increased, and the amount needed to put down dropped, right? Like that's
Well, I under promise and over deliver in everything. At least I try to, especially when I tell you what our beep, 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 beep updates are going to be. There you go.
Especially when you plan your golf weekends. So let me ask you something. You made it sound like what I'm used to hearing about rates dropping and terms dropping across a banking system. But you're making this sound like this is specific to a relationship that JWB has. Is it specific to a vendor and anybody that they do business with? Tell me a little bit more about how this happens.
Well, it's very relationship driven. So non-recourse lenders take on a lot of risk based on the asset that they're lending on. Okay, again, non-recourse means that if you don't make the payments and you borrow the money, they can't go after your credit score, right? They take the property back. Most banks don't want to take properties back. No banks wants to take properties back. They want to be in the business of lending. But banks feel better if you don't make the payments, that they can make sure that you can't buy another property for 7 years by attacking your credit score. So for a non-recourse lender, they take a tremendous amount of risk to be able to to create a loan like this, a loan product like this. And they have back-end investors that all demand higher interest to take on a riskier product. Well, one way that this relationship, that the non-recourse lender makes this happen, is they vet out your turnkey provider, or they should, the reputable ones, vet out your turnkey provider. So they have spent time here at JWB. They have talked with literally hundreds and hundreds of our clients now, and they've seen their success because they are their lender. They don't see them going to foreclosure or anything like that, losing the property, right? So they get confidence there. But they spend time here. They actually come and they see our properties. They spend time in our office here, because for them to take back properties is a big, big problem for them. And if that would happen, it would increase their costs. Their return on investment would go down for their lenders, their back-end investors. And then at the end of the day, they wouldn't have a very sound business model. So it is very relationship driven. The quality of the relationship between the turnkey provider and the track record allows that non-recourse lender to drop the rates. And that's exactly what's happened here with our non-recourse lenders.
That's amazing. Marilyn Cotterman from Homosassa, Florida,
Home in the manatees,
is putting in the chat, huge win on rates and loan time period for non-recourse. I totally agree. So I know that when you and I first started talking about me investing in rental properties, I was like, man, I had no idea this non-recourse stuff invested. Why don't I just put my 401k into that right now? And we decided to go a different route. How does this piece right now, this update to lower rates, longer term, lower down payment, how does that change my decision-making and not me, right? Asking for a friend here, right? Like, how does that change the decision-making process of whether or not I want to invest with my retirement funds versus my post-tax dollars?
Well, there's a lot that goes into the question of, should you be buying properties in your retirement accounts? Should you not be buying properties in your retirement accounts? It is absolutely something that you need to speak with an expert, speak to my team about if it's something you're considering. Because there are ways to sell you properties, or for you to buy properties in your retirement accounts that might be totally the opposite way of what your goals are in 5 years or in 10 years or in 20 years. And there might be a way that you do it and you increase your risk profile and you don't even think about it, right? There are limitations to buying in your retirement account. The first one that I think of is just making sure that you have enough money in your retirement accounts. You need to have more reserves than you do if you're buying outside of your retirement account, because the funds in your retirement account have to handle the good days and the bad days by themselves. Like, your retirement account has to be the source of money to pay for maintenance costs, or to pay the mortgage payment if you don't have a resident in there, if you have a vacancy, or to pay for tenant placement fees, or if you're holding on for 10 years to pay for that big expense that may come up in 10 years or in 15 years or whatever. It all has to come from your retirement accounts. It cannot come from your personal bank account. So it needs to be an extra level of planning and preparation to do that. So when you get to the question of how does it change your strategy? Well, we need to first understand so much more about it to know what the right move is for you. I will say, though, that in generalities, just this interest rate drop should not change overall for the vast majority of you whether or not you should be buying properties in your retirement accounts. It shouldn't change it, but think about it from this perspective. All right, our retirement account purchases, right? The non-recourse financing purchases, if you look at those, and we'll look at one in a second here, they're roughly about break even for cash flow. And that's a great thing, because you're able to put new assets, additional assets in your retirement accounts that eventually will be paid off and will create multiple income streams instead of just one. That's why you take that, and that's why you put 50% down or 40% down. You're able to get more assets. And so, and you don't need the cash flow in the short run, right? You're not going to touch your retirement account dollars. And if you had $100-200 a month in cash flow coming in, probably weren't going to touch that for, 10 years, 15 years, 20 years, whenever you got to 59 and a half anyway. So they're basically break even. The way I look at this interest rate drop is this extends the runway for us to be able to be cash flow positive as home prices go up over the next year to 2 years, right? If you're break even today and prices are expected to go up like they are, at some point, there's a real risk that your non-recourse purchases are cash flow negative, which is not what we espouse here. So that's the big takeaway here. This is a wonderful thing today, and this extends the runway of positive cash flow in the face of rising home prices over the next 1 to 2 years.
All right. I like it, man. We got a question from Raj Bantu. Raj, welcome back, buddy. Good to have you. How does non-recourse loan insurance work on properties? Are the insurance rates the same as conventional properties?
Sometimes, and sometimes not, depending on the type of entity that is holding the asset. So this is, again, everything about non-recourse purchases, everything in general. When you're thinking about buying a rental property, you need to start with your plan in place, and you need to think about what is going to change based on if I have it held in an LLC or if it's held in my retirement account name that is not an LLC. That can affect your insurance rates. So again, Raj, please talk to the team. If you have those specific questions, we can break that down for you. So you will know before you would make a purchase decision, you'll know exactly where you stand and how that may or may not affect your cash flow.
Yeah, there you go. So that's one of those chatwithjwb.com questions, because you can talk to the team, get the legit number answer, or if you're a JWB client, you just talk to your portfolio manager. All right, GC, we're going to jump to this property. I got a couple of, first of all, Sorry asks, what was the rate again? Sorry that they missed it.
It's 6.75% fixed for 30 years, and it's 40% down.
There you go. I'm down with that. All right, so we're going to jump into this property. We got a couple nice things said here in the comments and in the Q&A. Danny Davies writes, forget the loan itself, which is an incredible rate / down payment / time period. I've never heard of this. JWB might be the best localized real estate company in the entire country. An accredited financial institution just validated it. Proves that JWB is just about as risk-free of an investment option as one will ever find. That's really nice. Wow. Really nice.
That means a lot, Denny. Denny and his family have trusted us for a long, long time now. Denny, let us know how long you and your family have been investing with us in the comments. I'm guessing 6 years, 7 years, 8 years, 10 years. And just that quality, that relationship we have with you means a lot. I appreciate those kind words. It means everything. Thank you.
Yeah, he writes nearly 10 years, and he's tuning in from Germany, right? Making the time to join us from across the pond. Bill Shields just checked in. Buenas tardes, amigos. Sorry I'm late. Bill, I like the Spanglish, both Spanish and English. I appreciate it. And then Lee Bishop just wrote something here in the Q&A that we're going to read out. Love that JWB looks out for me with my retirement money in properties. I got a call from my portfolio manager, Sarah, today about a client that missed a payment this month. If the tenant does not make a payment in a week, the eviction is going to be initiated. The tenant said they were going to pay. There were some issues for this house that had to be corrected and were. Lucky that this issue did not mean the tenant did not have to leave. I asked that the management team member involved tell the tenant that the owner is allowing for additional week pay. Sarah and I discussed the tenant re-sign and get a deal versus turn for this property. That the tenant re-sign and get a deal versus turning this property. Very flexible, and that was very nice having that kind of control and interaction with JWB. Very impressed. All right, good stuff, Lee.
Appreciate that, guys. Lee, it's wonderful. Thank you so much for sharing, guys. This is awesome.
Yeah, it's cool, man. All right, so now that we're going to share the property of the week. Week. Magically going to whisk you away to 1301 Orton Street, Jacksonville, Florida, 32205. That is a purchase price of $255,000, 4-bedroom, 2-bathroom, 2-car garage, leased out 2 or 3 years for $1,558. And let me know in the chat if it's all clear, or if you want me to zoom in, or if it's fuzzy or anything like that. But this is what you're coming to the asset class for, right? You're coming for this estimated conventional. Let me zoom in on that.
Yeah, I think you zoom in there.
There you go. Oh, yeah. Make it nice and big right here.
There
all right.
Go.
estimated conventional financing total monthly cash flow of $131, and estimated conventional financing total ROI of 7.32%. GC, like we always do at this time, tell me what this total monthly cash flow represents.
Total monthly cash flow to me represents risk mitigation. I love this asset class first because of the way I'm wired, and maybe you might be wired, is risk mitigation comes pretty naturally to me. That's how I think, right? When I'm looking at opportunities out there, I'm like, okay, how do I make sure that I'm not going to lose the farm, but I also potentially have upside? That risk mitigation matters to me, and it should matter to you. When you see an asset that you can buy that has expenses, including the fact that you're going to take out debt on it, that's an additional expense on there. But the income on a monthly basis offsets that debt and offsets that expense. So it's actually positive cash flow. That's risk mitigation. That's what allows you to have the confidence to go and buy not just one rental property, but maybe 3 or 5 or 10 or hundreds, like my team and I have. Thousands we've bought, right? Between the properties that I own personally and the ones that we have in our JWB inventory. Listen, if every time JWB bought a rental property, we thought that we were going to be shelling out hundreds of dollars a month in the holding cost and all the other costs, I wouldn't have thousands of properties in our inventory right now. Like, risk mitigation really, really matters. And it should matter to you whether you're buying one property or buying 1,000. And the easiest way to identify this is this asset going to pay for itself every single month on a normal month? Here for this property, you can see an estimated $131 a month. This property is paying for itself every single month. And that's a beautiful thing. And when you do that, most of you who are buying rental properties, investing in rental properties, have a goal that is larger than, call it $500 a month or $1,000 a month in income, or maybe even $2,000. Your goal is maybe $5,000 or $10,000 a month. It's pretty common for what we hear from clients. Well, if you have a goal of earning $5,000 a month in monthly passive income, or $10,000 a month or more, you're going to need to get really comfortable with risk mitigation. You're going to need to get really comfortable with scaling, because you can't get there by only owning one property. You might need 3 or 10 or more. So when you see this asset class that can pay for itself, you see $131 there, to me, it's just got to be positive, right? Because that's not going to be the biggest profit center for you. You just got to make sure that that number is positive, that it's paying for itself every single month, that it allows you to stay in the game for a full market cycle. So then you can then maximize the other profit centers that I'm sure we'll be talking about here in just a second, right, Pablo?
I think you got exactly 1 second. And why don't we talk about this total ROI here of 7.32%? And tell me about these other 5 profit centers.
There you go. Love talking about the profit centers. So this 7.32%, what this should represent to you is, how hard is my money working for me overall, right? If you only look at $131 a month in cash flow, those returns could be incredible. Your money could be really working hard for you, or it could be measly, right? That 7.32% takes all of the income coming to you, as well as a couple other profit centers, and it divides it by the amount of capital that you put into it. And that's your return on your investment. That's how hard your money's working hard for you. And that's a really important thing. If you think about yourself as a financial engineer or an asset manager, your job is to make sure that your money is working hard for you. So 7.32% is a great percent. And get this, this only takes into account what we have relative control over, meaning your net rental income, right? JWB is your property manager. We feel really good about collecting rent for you and keeping your expenses low. Well, we have a lot of control over that. So that's a part of that 7.32%. Right. We also know that there are certain tax savings that you get from being in this asset class. It's part of the IRS code. So we feel pretty good about that. So that's included there, the tax savings. And then the principal pay down. Your loan has an amortization schedule. And as your resident pays your loan down, as they pay rent to you, they're paying your loan down for you. That's happening every single month and every single year as well. So that's the elements that it takes into account. You divide it by your initial investment. And out of the 5 profit centers, those are 3 that are accounted for there, and that 7.32% number.
Those are 3. And I know that there is two more, right? We've got the inflation hedging and we got total appreciation of the property. Before we go into that, I just want to say we've doubled in attendance in the last like 10 minutes. So I'd love to just welcome everybody that's joined us in the past couple of minutes. We're up to 30 attendees. Happy to have you here. If you want to check in the chat, this is a totally interactive show, right? There is a couple of different ways to interact with us. One is in the chat, and you can comment straight to us, or you can change that box and make it to everyone. And that way everybody can talk to each other and you can get some advice from people like Lee Bishop and Denny and everybody else that's in here, and Bill and Sorry. And then there's the Q&A, right? If you have a question to be asked, pop open that Q&A box, throw it in there. And I got a question for you right now, Greg. If there's 5 profit centers and we've gone over 3, how come this appreciation rate down here is at 0%? I thought you said that that's a profit center.
Appreciation is a huge profit center. In fact, at the end of a full market cycle, if you look back at the percentage of your total return on investment broken down by profit center, you're going to find that home price appreciation actually is the largest component, especially if you use smart debt like we talk about often here. It's the largest one. We actually just did our case study on Tuesday breaking this down and showed that for a normal property, 64% of the total return on investment after a full market cycle comes from home price appreciation, which is surprising because most investors only pay attention to cash flow. Cash flow is like 10% of your total returns over a full market cycle.
Yeah, I'm just going to iterate that. 5 profit centers, 65% of it come from home price appreciation, right? Like that is 3x what if you were to divide it evenly between all 5.
Mm-hmm.
Yeah.
Mm-hmm. So the home price appreciation thing is a nuanced subject, though. You can't go all in on home price appreciation and forget about cash flow, right? You can't go all in on home price appreciation and think that you're going to get it year over year over year. We have many, many examples of this in the last 15 years of how that didn't work out well for people. But what people they fail to realize is that home price appreciation is actually pretty predictable given enough time. And that time period is 10 to 20 years. If you are buying and holding real estate and you were wondering what type of average appreciation rate you can expect for your properties, you almost have the answers to the test. It's there. You can go back and look at your individual market. It's free data too. It's Federal Housing Finance Agency. They put it together for you. And you can see what your market's average appreciation rate has been over the last 30 plus years. And then what has been proven over 10, 20-year segments, your home price appreciation over the next 10 or 20 years is largely going to be consistent. In Jacksonville, that number is 4.3%. Going back from 1991 all the way to present day, the average appreciation rate is 4.3% per year. So if you're buying and holding in a market like Jacksonville and you plan to hold for a full market cycle, you can count on home price appreciation. And this is what separates the Jacksonville market from other markets out there. You got to look at all 5 profit centers. Right? You got to be buying and holding for a full market cycle and look at all 5 profit centers. And that's why I have my money in the Jacksonville market, and our clients do too. If you go to other markets, you'll find some that have higher cash flows than JWB. That's great, right? But you won't find that same combination of positive cash flow plus home price appreciation plus benefits from all 5 of the profit centers. That's why holistically Jacksonville is the market for me, and that's why JWB clients choose Jacksonville.
There you go. So if we are choosing Jacksonville, we are in it for the long haul, right? Sarah Jennings wrote in the chat, what is a full market cycle? Lee Bishop answered at least 20 years. I think, Greg, you defined it. It's somewhere, it hits somewhere post 10 years and somewhere around 20 years, right? It's kind of like the full market cycle.
Yeah. 10 to 20 years is what history has shown us. And if you go back and you look at market segments or market cycles within that 10-year, 15-year, 20-year period of time, you're going to find that most of those market segments, those cycles go right back to what that historical rate of appreciation is. And that's why we know it to be between 10 to 20 years generally.
That's right. So if we're in it for 10 to 20 years, right? As I am, as you are, Greg, as a lot of our investors are here, we plug in that 4.3% and we see these numbers, right? This originally 7.32% rate of return goes way up to 22.96. And by the way, since we had folks join late, if you go to jwbinventory.com, you can download this sheet and you can mess with these numbers yourself and plug in whatever appreciation rate you want and a couple of other things that we're going to go do right now. But GC, why don't you give a quick explanation of why, when just adding 4.3%, it went up 16%?
It's the beauty and the magic of smart debt. Smart debt is debt that pays for itself every single month, right? We just talked about that positive cash flow. It needs to pay for itself every single month with the asset, the underlying asset. It needs to be relatively inexpensive, right? If you can borrow money at 4% or 6.75%, I mean, that's relatively inexpensive money, especially for non-recourse. We know how high it's been in the past. And if we're talking about conventional financing, borrow at 4% it's just unheard of. The ability to borrow money for 30 years at 4% is the greatest generational wealth creator. It's that is the deal there. And then the last part of smart debt is to be able to invest in assets that historically go up in value over time. That's real estate. So this is what smart debt can do for you. Well, when you take out smart debt, and it's not overly risky, right? It pays for itself every single month. The market value increases, that 4%, call it gain every single year on average, right? That 4% gain is not a 4% return. If you only put down 25% and you earn 4% on the asset value going up, your return on investment from that appreciation is actually 16% just on that home price appreciation, right? Like, think about this. Like, we all think like, man, I got my money in the stock market. Okay. Many of you do, right? If you could go in and say, geez, I want to earn a 16% return on a stock, you do it, right? That's a win, right? I mean, maybe your threshold's a little bit higher, but 16% in the stock market is better than I've ever done, right? In real estate, to accomplish that same 16% gain, we're only talking about appreciation here, right? In the stock market, you don't get extra tax savings. You don't get principal pay down. You don't get any of that. You're just talking about your gain from appreciation in the stock market. You need your stock to go up in value 16%. Well, in real estate, take the positive cash flow out of the way, take principal pay down, take inflation hedging, take tax savings. Don't even talk about those. To get to that same 16%, you just need the market value to go up 4%. And what has the market done on average through the good times and the bad times in Jacksonville for the last 30 years? Every year on average, it's gone up 4%, 4.3%. So you're already to that same level of appreciation that you may or may not be expecting in the stock market for a huge win. And then on top of that, you throw these other 4 profit centers on, and that's how you can get to a return on investment of roughly 23% here. It's because it's that 16% roughly from home price appreciation, plus call it 7% from those other profit centers like we just talked about.
There you go. The beauty of leverage. You know, GC, as I'm just going to air out some of our laundry out here, right? But like, as you're talking about this, as it dawns on me that this is, you know, this is the thing that really landed on me of, you know, when I was telling all my friends about how awesome this all was, and before we started doing the property of the week, and we would go over this wonderful magic trick of smart debt. And I finally understood the beauty of leverage, of this idea that no other asset class allows you to get, you know, make money based on, you know, one part your money, one part borrowed money, and this like mechanism. I feel like this idea of smart debt is that's the thing to evangelize in rooms with other asset classes, right? Like you can walk into a room full of crypto investors and be like, oh yeah, cool, man, you can bet on crypto and whatever. How are you, you know, like, you're making money just on your money, right? Like, you're not making money on something else. And like, explain this mechanism, you know, in relation to dividend stocks, in relation to bonds, in relation to way riskier stuff, and just talk about that trick. That might be a real good, like, lightning rod of showing people the light of the beauty of rental property. Cause I don't think it happens in other, right? Like this doesn't happen in other asset classes. Like, does this even happen in like syndications? Can you borrow money to put into a syndication?
Yeah, syndications can take advantage of debt, but generally the terms are not nearly as good of the debt. So like in a syndication, you're getting largely commercial rates, that those loans that the syndication, that the company that you're investing in is able to acquire, are not the same Fannie and Freddie backed loans. Because they're backed by Fannie and Freddie and they're to you as an individual, you're able to get 4% rates, right? The loans that we get, right, more commercialized loans for some of our bigger packages are not at the same 4% rates, right? They might be at 5% or 5.5% or something like that. So you can take advantage, and syndication can be a great thing as well. But if you're looking at the absolute best benefit from leverage, it's your Fannie and Freddie backed loans, which you're allowed to do as an individual rental property investor. You're just not able to do that on large scale. It's that Fannie and Freddie don't work that way. Your down payment percentages are higher for the commercialized loans as well. So the syndications will have to put more money down in order to do it. So that would lower their return on investment. So syndications are probably the next best thing as far as taking advantage of leverage. And it pales, but single family investing as an individual will be higher. Your benefits from leverage would be higher. But your point is 100% spot on. And I'd love to hear the group's feedback on this too. I would love to hear, Pablo and I are always searching about what's speaking to you, right? Out of the content that we're putting out here, what speaks to you? And everybody here on the show here, I see so many familiar names and faces. You guys tune in every single week, and we're so thankful. Like, you guys have heard us talk about different things. I would love to know if the leverage part of the conversation speaks to you. If it doesn't, I would love to know that as well, because it's one of the great differentiators between the other asset classes. The ability for a bank to lend on a house, which is shelter, which is that demand for that product's not going away, allows them, along with a number of other things, to create loan products that their back-end investors believe in, that allows rates to be so low, that allows terms to be so long, and you don't have that same underlying asset in other asset classes to take loans on. Right? So you're 100% spot on. Like, that is one of the things that I love the most about real estate, is the ability to take out smart debt.
Awesome. Yeah. Please let us know in the chat, right? Like, what is it? What topics came to you? Denny Davis is putting leverage equals number 1, 2, 3, 4, 5. The top reasons I invest in real estate. Yeah. And Denny, that's a great one. If leverage is the reason why you came to the asset class, or what it made you curious about it, how'd you find out about leverage, right? Like, how'd you find out about it? Kind of like I would love to hear some anecdotal evidence from you right now in the chat of the topics that brought you here and the topics that we opened up your eyes to that you didn't know existed since you've been coming to the show, and that keeps you coming, so that way we can, figure out how to get this information in other people's hands, right? Like, we're trying to make as big of an impact as we can. So we got a question here from Daniel Lee, a really good question here. So he writes, "Hey, Gregg, does JWB offer any qualified opportunity zone funds or properties available for investment? I have capital gains that I'd like to tax defer, and I cannot 1031 exchange. If not, are you able to recommend other opportunity zone opportunities in the area? Thanks."
Love the question there. Opportunity zones, if you haven't looked into those, could be a big game changer for your wealth creation over the long haul. Opportunity zones basically allow you to defer your income, which is just like a 1031 exchange, right? It allows you to sell a property, even allows you to sell other things beyond just real estate, and then put that into properties or businesses in designated zones in an area. And when you do this, you're able to defer your taxes, very similar to how you do for a 1031 exchange, but you're also able to avoid paying capital gains taxes on the profits, on the appreciation, if you hold on to that asset for 10 years. Okay, now I'm not a CPA, and there are so many things you have to look into with opportunity zones. So I'm just giving you the real high level information there, but it's something internally, JWB, we do with our own money, right? This is a way for us to maximize our profit potential on the holdings that we have with our properties. So I would absolutely, if you're curious about this, talk to your CPA. It is one of the biggest opportunities and also one of the most technically challenging things to do. I mean, we have spent probably hundreds of thousands of dollars understanding how this can work for our opportunity zones that we have created for ourselves. Now, I think the bigger question, the one that matters more than what JWB is doing internally, is do we have properties that fit into these opportunity zones? And the answer is yes. It's really fun and exciting to think about these properties that we're talking about here, like this. I don't know specifically if there's one on Norton, but I know these defined zones, a large amount of those are in our own 4 neighborhoods, our key neighborhoods. So Yes, not all of our properties are in opportunity zones. I don't think you would expect that, right? Our neighborhoods were defined before the opportunity zones were defined. That really is just from the 2017 Tax Act that came through. But yes, there are opportunity zone properties that you can find here at JWB, and I would encourage you to reach out to my team to have that conversation. The next step is, do we offer opportunity zone funding investments? And the answer is no. There is just way too much to think about creating opportunity zone fund investments for another investor. The upside would be huge, and I've looked into this. I wanted to do it for our clients. But there are so many hurdles. It's just not even possible. So yes to properties. If you have your own opportunity zone fund and you want to add properties, we can help you identify ones that it may be in an opportunity zone here. I'm going to tell you, 99% of you out there probably aren't going to do opportunity zones. You don't have to, right? They're great investments if you don't. But for those of you who are doing opportunity zones, please reach out to our team. We can help you navigate that. We will not be a provider for you of opportunity zone fund structures or syndications or companies that we would have you invest in with us. Just too many hurdles to do. And I would really advise you to talk to your professional team, CPA, lawyer, to be able to learn more about it.
Okay. So I left that one a little bit confused, GC. So that means that you do have homes that are in opportunity zones, but there's some other lever that in order to invest to get the benefit of an opportunity zone, you got to have some stuff in place on your end in order to do that. Is that kind of what you're saying?
Yes. You have to create your own fund structure. And with opportunity zones, there are also a ton of limitations. Like, for example, in opportunity zones, you have to purchase the asset and you have to do it in a way where the amount of improvement you do in the property has very real requirements. You have to, I can't remember what the requirement is, but after so many years, you have to call it 50% more of the basis into the property in order to be able to have it qualify for the opportunity zone. Because what the government is trying to do is to encourage, and the reason they're giving these big tax incentives is for encouraging investment in property and businesses in opportunity zones, which have largely been in underserved communities. So they want you to invest a lot of money and they want you to stay there a long time. And if you do that, then they're going to give you these incredible tax breaks to do that. So you have to have all of that set up in advance. You have to have the structure that can acquire a new construction property or a renovation property that will allow it to meet your criteria for whatever your opportunity zone structure is. There's so much to it that the way I would take away from this conversation, be cool for you to spend a little bit of time doing your due diligence on opportunity zones, because I think it's really cool, right? The other thing is not necessary for rental property investing. For the very small percentage of you where it could work, JWB does have properties in opportunity zones. Worth a conversation, right? Maybe we could help you acquire that property in the right way for it to work with your fund that you have set up. For almost every single one of you, probably not. You probably don't have a fund set up. And even if you do, there's a really good chance that the property that we have, because you haven't set your fund up in a specific way, wouldn't qualify even if it was in the neighborhood. So I think the opportunity is huge. I think the chances of our properties actually being used by our investors as opportunity zone fund properties, really small. But if that works for you, great. We would love to make it happen.
Awesome. All right. Daniel says, thank you. Very helpful. And he liked my clarification. So Daniel, I don't know, that might be a chat with jwb.com question, right? Like hop on a call and just kind of like dial that in. But I thought that was good. And it begs the question that George Martinez is asking, what are opportunity zones? How about we just give a quick one on that one?
Yeah. So opportunity zones I think they were chosen by the governor of the individual states. They basically designated zones, like areas in your city that have been underserved. And the government wants more dollars and investment to be there. And so the government came up with a structure so that you could get huge tax incentives if you pour a lot of dollars into properties that are in these underserved communities. or if you build businesses in these underserved communities and you hold on, you put a lot of your dollars in, you hold on for at least 10 years, there's a ton of tax breaks. The best tax breaks I've probably ever heard of from holding assets, right? If you hold on for 10 years and the value goes up, you don't pay taxes on the gains, right? Like, man, I don't know another structure like that, right? So there's huge opportunity to do that. Government, of course, has so many rules to follow, and then you need to be there for a long time. But it's an incredible opportunity and something that you have to spend a lot of time and money setting these things up. And then you have to go at it with a laser focus. And generally, for those who are taking advantage of it, they are not passive investors. They're active investors.
Got it. You know, it gives me a little bit of nostalgia, man, because before you and me embarked on our content journey, when I had just met you, we had just played volleyball, and you were like, I want to make content. And I was giving you a little bit of advice. You're like, I'm going to go do it on my own. I remember the first thing I saw you do was like a Facebook Live about Opportunity Zone. So yeah. I'm like, this bring me back a little bit.
I've been excited about it. I wish it was palatable to bring it to our clients and to the masses. It's just not.
Cool. All right. Well, let's make some more stuff palatable here. We got, but by the way, I'm definitely going to get to the questions inside the chat. And it so happens that it works out okay that I can do it because there's not a lot going on in the Q&A, but I do recommend that if you want a question asked, put it in the Q&A because the chat moves really quickly while the Q&A stays like in front of me. So I might lose track of it. That being said, I'm not losing track of Jad Chada's question. Jad, welcome back to the show. Happy to have you. He says, Greg, how do you choose your lenders? Sometimes one has access to lower rates with other lenders and makes the numbers work better.
Yes. At the end of the day, the way we choose our lenders is because we want the best rates and the best experience for you. And the best rates conversation with lenders usually goes pretty easily, right? You can talk to any lender out there and they can say, I got better rates than the next guy or the next girl, right? I got better rates. You can go to your local Bank of America and go to see the window there. And they're like, well, you can get an interest rate of 3.25% on your home or whatever. There are so many other, what we call overlays in between the rates that are posted or advertised by loan officers or brokers out there versus what you can actually get on a turnkey rental property in Florida. And it's so how do we choose our lenders? It's both of those things, best rates and best experience. Best experience is the tougher one to find. And the problem with understanding best experience is you have to go through loans with people, dozens and dozens and dozens and hundreds of loans with lenders to find out the ones that actually can uphold the experience. And the biggest problem with the experience with lenders out there is not that their customer service is lower. That also is a very big problem. The big problem with lenders out there is that they can't close. And the most frustrating thing is that the reason they can't close was known by a part of the bank when the loan started, but it wasn't known by the loan officer. These are these overlays, right? Like a common one, and there are hundreds of these, but a common one will be how long the previous owner has owned the property, right? So for JWB, right? We're in the business of turning over assets quickly. That's what we do. Right? We buy an asset, we build it, we put a renter in there, we sell it, right? We hold on to these properties for less than a year almost all the time, right? From the time that we bought it to the time that we built it to the time that it's actually sold, right? It's a short-term thing. And if it's a renovation, right, it's not nearly a year, right? It's months, right? So if you're going out to get a loan and you're with a different lender, and they don't know this overlay, which is title seasoning, how long the previous seller has owned the property. They could tell you the best rate, you have the best credit score, you get all the way to the end, and the underwriter, who you don't get to talk to until the very end, said, I can't approve this loan because JWB didn't own this property for 2 years. Like the 2-year seasoning overlay, right? There's a ton of other overlays. The problem is you can't understand every single overlay for every single lender and what happens and what has happened in JWB's experience, right? 10 years ago, 15 years ago, somewhere in the early part of our organization, we were open to working with outside lenders. At that point, we didn't have a stable of 10 lenders that had done dozens and hundreds of loans with our clients, so we didn't have that experience. And we opened it up. And what we found time and time again is that the experience for our clients was terrible because lenders couldn't close. And so for us. And then financially, it's risky for an institution like JWB, right? 60% of our clients use financing. If I'm opening up the door for 60% of our loans, our sales every single month to maybe not close, or, I mean, that's not good for JWB either. I got to think about the 80, 85 people in our office, right? So that's why we require that a client who is going to be working with JWB, buying a property with JWB, that you work with our network of approved lenders. It's for best rates and experience. And we make sure that we have the best rates, of course, with our lenders. We're always talking about what rates are. The best rates win, right? We're going to put you with the best rates. Sometimes that changes. One lender might be better than another, and that's where their client volume goes. And the other thing to point out, many times this is a question. People wonder if JWB makes a kickback or a referral fee. Many turnkey partners make a referral fee by who they refer you to for their lender. We do not. We'd make zero money on the referral. And I think that's important because we simply want you to have the best rates and the best experience. Whereas it can get muddy, right? If referral commissions are involved there, like this is a sensitive thing. It's hard for some people to, fully buy into the fact that their friend or their other lender might offer a rate that's half a point lower than what somebody else is. But the reality, this has been proven over 15 years of experience, is that rate isn't real. They can't actually close it. And so that's how we get to our network of approved lenders.
Makes a lot of sense. Jag says, thank you, Greg. Very informative. Man, I like that, GC, right? Like I'm, as a guy that is very much a connector and is very networked and blah, 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 blah. I'm always giving people referrals and people always want to give me kickbacks. And I'm like, I don't really want a kickback from you because I don't want to owe you a referral, right? Like I don't want to be incentivized in the wrong way to give you business. I rather you just make sure you treat whoever I send you over there, make me look good. And I'm going to continue to do that because I know it's good for me long term, right? As opposed to like, give me $500 and then now I'm going to be like, I'm going to do this for $500. It's not worth it.
It's because your relationship is that's what you trade.
Yeah.
You're trading in your relationship. For JWB right now, we're trading in our relationship and our reputation.
Yeah, totally. And that's long-term thinking. All right, man. We got another good question from my buddy, George Martinez. So I say my buddy, George, I don't know where you're from, man, but like a name like George Martinez, I grew up in Miami and that's like, I have like 12 good buddies called George Martinez.
You can pronounce this one, bud.
Yeah. I can pronounce that one well. Too soon, Greg. Too soon. All right. George Martinez writes, going over smart debt. When would a non-recourse 40% down, 6+% be better than a conventional 25% down, 4+%? Sorry if I'm missing details on the questions. I think George would love a primer on what is a non-recourse loan versus a conventional loan and when you use it.
So the question is, when would 6.75% interest, 40% down be better than 4% interest, 20 or 25% down?
Yeah.
Answer there is never. So, but the reason I'm being a little facetious here is you're 100% right. Like the rates are different for non-recourse and conventional. You would only get excited about a 6.75% rate and 40% down if you did not have the alternative of 4% rates with 20% down. And that is what makes 6.75% shine. Because when you're buying properties in your retirement accounts, you cannot get a conventional loan, because a conventional loan, it comes from a lender that then that loan is sold to Fannie and Freddie. And those loans have requirements. One of the requirements is that it has to be a recourse loan. Recourse means that Fannie and Freddie aren't going to buy that loan from your lender unless the loan that the lender originates says, if you as the borrower don't pay, your credit score can tank. That's what recourse is. They need recourse to go after your credit score. Well, in buying a property in a retirement account, George, your retirement account is buying the property, not George. And your retirement account does not have a credit score. And so for a bank to make that loan, it has to be a specialized product that does not have recourse, a non-recourse loan. So for your retirement accounts, you're not going to have the opportunity to get that same type of rate structure. And hopefully it makes more sense now too, because the risk profile for the lender and the investor in the back end is completely different, right? There's two ways that they can account for risk as a bank or a lender, right? One is taking the house back. Banks don't like to take houses back. It's really bad for them, right? And the other is making sure that they can go after your credit, which increases the chances of you paying your loan. The one that they really like is recourse. If they can't do recourse, it increases their risk profile. And that's why there's only a handful of lenders that specialize in non-recourse in the entire country. And the number of who are reputable and who can get the best rates and the best experience is really, really small. And we work with them. And so we're happy to make that introduction for you.
There you go, George. And listen, coming from I'm not really a real estate expert. I just play one on TV. I've just gotten to hang out here in this group of really brilliant people for the last year and a half. It was news to me that you can buy a rental income property inside your 401k, inside your IRA, in that similar kind of mechanism. And that's where this comes into play, right? They use the words non-recourse. It sounds real fancy. It essentially just means you're buying it inside of your IRA or you're buying it inside of a 401k with retirement money that is pre-tax, right? So like you do that if that's the play that you're doing, and there's certain ways to do that. And I've had the great benefit of talking it a long time with Gregg. If you want to talk about how you do that stuff, go to chatwithjwb.com and they'll give you the great advice that he gave me as well. But most of the time I ended up going with just a regular loan, right? Like for me, it was like, I have this much in my retirement account, but I have this much down payment. You have more options of just buying it with post-tax dollars and how you can finance it and how you can get to more of them and stuff like that. I ended up doing that twice this year. So just a little scope from the noob over here, from the rookie. All right, GC, this was a good show, man. Great questions. I would love to, what is Jag saying? Please share the name. Lee, please share the name. Jag,
well, I saw the question. I think Jag said, or maybe somebody else might have been Sori who asked and said, I'm working with another non-recourse lender that offers 40% down and a better rate. I probably know the lender you're talking about, Sori. And if it's the same one, we've worked with them, and we choose not to work with that lender again, because it comes back to experience, right? So again, the rate is the easiest thing for a non-recourse lender or any type of lender to advertise. But the fact is they're just not going to close with a high close ratio. Like I have an actual story with a different non-recourse lender. Again, been doing this for so long, probably 8 years ago, 10 years ago. A client was buying 2 properties from us. There were 2 new construction properties. They were right next door to each other. We went through the non-recourse loan with a different non-recourse lender that we choose not to work with now. They approved, and the client was obviously a very easily approved, right? Credit score, they do run your credit, but more reserves than they needed, all this good stuff, like ideal loan opportunity. They approved one loan for one property and denied the next loan. The exact same property, right next door, built by the same builder on the same street. And that's reality. These many lenders, especially non-recourse, can just choose just to not approve loans because of which way the wind is blowing. And that's a really poor client service experience. And the worst part about it is they can't tell you why. They won't tell you why, or the reason they give you doesn't really make any sense. So, it's just not a good experience. They just don't have a high close ratio. And listen, if I could find a better rate for you, just like we found here, that I had confidence could close, we would work with that partner. We've worked with a lot of them out there, and don't have confidence that would be a great experience for you.
Also, I'm not sure Jag was here at the beginning of the call where we broke the news that they literally just lowered the rates and lowered the terms.
There you go. Well, that too.
Yeah. So important for you to kind of like frame that whole thing of like how much you vet them and whatnot, right? I think it was Lee that just got somebody new. I think he's working with Bob Cash, and yeah. So Jag, so what happened is you may have gotten that rate a week ago. We literally just had an update with one particular provider that JWB does business with that lowered their lower the rates, lower the term, and lower the rate, up the term, and lower the down payment amount. So that's probably why you're hearing that.
There you go. 6.75%, 40% down, and a 30-year term now is what you can get with JWB's non-recourse properties and lender.
There you go. That was up breaking news at the beginning of the show. All right. So we've reached time. I wanted to save a little bit of time here. I don't know. Daniel Lee's got something here. Daniel Lee writes, regarding interesting topics, discussing real life property management issues, tenant horror stories and actions JWB takes to help investors might be interesting. Lee's example in the Q&A on actions taken to resolve a problem and the option to re-sign rather than turnover is quite interesting. Daniel, I got good news for you. We talk about that stuff all the time, buddy. So keep coming back because we have those, right? So like the experience, what you do to do it over. You're going to hear that a lot when we have past investors, right? Like we talk that come to the show. Lee's been a guest. We have a bunch of past episodes. We can get you some of those. Join our Facebook group, jwbfacebookgroup.com. We talk about that a lot in there, but we love the suggestion. Thank you, Daniel, knowing that that's really important. I think, Greg, you love airing out the dirty laundry, right? Because you love setting expectations.
It really comes naturally for us on this show is, we talk a healthy amount about the upside, but I think we talk more about the downside. And I want it to be that way. Too many people just see the upside in rental properties. They don't see the downside, and then they're left with a poor taste in their mouth. And I would rather it be the opposite.
Yeah, totally, man. Totally. You're all about setting expectations with everybody you work with. I remember our first meeting was awesome, man. So I'm going to read out. Denny Davis had another really awesome kind of thing he put in the chat. I'm just going to read it out, and then we're going to talk about what the next show is going to be. But he puts, Denny Davis writes, I had lunch one afternoon with Greg, Adam, and Adam 9-ish years ago, learned about all this stuff over a potluck meal. Thanks to leverage, put in an offer on 3 properties that afternoon, and instead of the one that we were planning to buy, and it worked like a charm. Those 3 original properties in our portfolio are now up over 100K each in the last 9 years. And thanks to leverage, we continue to add. It's beautiful.
It's really special. Denny, thank you, buddy. Thank you. And I will point out, Denny's ride hasn't always been smooth. Denny's properties have had problems. Like I shared with you, if you invest for long enough, you're going to have problems in your rental properties. The key is just making sure you work with a team that can solve them. So it's important for everybody to recognize with that comment right there, which I'm so thankful for, Denny. Denny's ride has not always been rosy. And, but that's what rental property investing is. You look back after a full market cycle, 10 years, 20 years, you're like, man, my money worked so hard for me. I had to deal with a little bit of bumps along the way. That's real. But look what I did for my family, for my generational wealth. That's where Denny is.
Yeah. And that's funny you say that because he did write that in the chat. I was just being short. He puts, keep in mind, we definitely had struggles over the years with a few of our tenants. You get the good with the bad, although JWB has definitely tightened the reins on tenant applications over the years, which is great. But despite evictions and the occasional trashed property, our returns are still sky high because of leverage, even factoring in some of the frustrations. Not to sound cliche, but investing through JWB quite literally changed our family outcome. Pretty cool. Pretty cool.
Man, I'm getting chills over here. That's just real. That's as real as it's going to get right there. Denny, thank you, buddy.
Yeah, man. I love seeing your face. Lee put in the chat. Love to see the expression when Greg gets hit with those. And it's wonderful to see the transparency and the answers. I think it's wonderful to see you smile whenever you hear these. Like I see you like really just like soaking it in when people, when our Not Your Average Investor Show fans write this stuff in here. GC, next week we got an interesting show, man. We got the head of the Jacksonville Aviation Authority talking about how Jax is going to be a future space tech hub and the impact of that for rental property investors. Anything you want to tease about that?
Oh man, I'm so excited for this call. I'm going to learn so much on this call because Jacksonville Spaceport is something that I'm convinced is going to be a major center of economic influence here in Jacksonville over the next market cycle, right? Over the next 10 to 20 years. And it is, and I don't even understand it yet. I don't think many people understand it, right? But we're going to have the CEO of JAA, Jacksonville Aviation Authority, Mark Van Loo, on the call with us next Tuesday. I'm so honored to have him on the call. You guys have asked for more and more influential leaders here in Jacksonville, and Mark is a great example of that. So if you want to find out about what's coming next in space, in Jacksonville Spaceport and commercialized space travel, and how Jacksonville is set up to be a major player in that field and you want to hear from the guy at the top, make sure you're here with us on Tuesday. It's going to be a great call.
Not just that, on my onboarding call with him, I didn't realize that JAA uses real estate data to lure airlines in. So he's super keyed in on like real estate trends and what's growing and who's moving in from where. So I think that that's really, really interesting. That's like, they take the data of like investors and people buying homes and are like, hey, we need a direct flight to Sacramento. Who wants to do it? Southwest, you in? You know, like that type of stuff, right? So I think it's going to be really cool. Like the time between real estate and airlines, I think is going to be a really, really interesting conversation. Man. Listen, we promised if you wanted to find out about owning rental properties in your portfolio, you came to the right place. If you wanted to find out about property management practices that were great for rental property owners, you came to the right place. If you wanted to find out an edge on the Jacksonville real estate market as a real estate professional, you're in the right place. Next place to go is chatwithjwb.com. I'm so grateful for the 30 plus people that hung out with us for an hour. It never goes unnoticed that you took an hour of your day in the middle of a Thursday to hang out with me and GC. I'm going to do a special shout out to Mal Washington, who's in the audience, just because I'm a tennis fan. I grew up like thinking that he was awesome, and he's a local philanthropist here. I can't believe he comes back for these shows. Good to have you here, Mal. But thank you everybody for being here. You make the show happen. Great questions by Daniel and Lee and George and everybody and Denny's. And, everybody that was bringing in questions. You make the show great. GC, I'll give you the last word, buddy.
Thank you guys. Thank you guys, especially to those of you who said such nice words, Denny and Lee and others on the show. You guys, I mean, it's cool. You guys picked up on like how much that matters to me and to my team. I mean, that at the end of the day, let's be honest, we've done this, bought over 3,000 properties, sold over 2,000 properties, right? The mechanics of buying and selling properties at some point aren't what drive. Right. That wasn't, my first time I did it. That's what drove me. Could I actually do the mechanics? Right. Now for my team and I, it's like these stories, right? How do we create more experiences like Denny, right? Or Lee, or all of you out there. So thank you so much for sharing. It means a lot. And I also want to say thank you again for everybody being here on the show for this long. Just to share with you, I was talking with a couple of other marketing partners and opportunities, and I'm talking about our show, and they're just absolutely blown away that we have 30, 40, 50, 60, sometimes 70 folks that show up for an hour midday, Tuesdays and Thursdays to hang out with us. And that's all you guys. And so I'm just so thankful and appreciative. You guys are the reason that we do this. Thank you. Please keep coming back because we have so much fun with you guys. And we would love to hear more and more of your thoughts and ideas on how we can continue to make this engaging. So thank you guys, and can't wait to see you next week.
All right. See you Tuesday.